Hello, everyone, and welcome to today's webinar, Is Your Remodeling Business Prepared for a Recession? It's presented by our valued industry partner, the Aspire Institute. Now, before I continue, my name, by the way, is Plamena Todorova. I'm Director of Credentialing and Education. But before I continue speaking, I'd like to check if we have audio. Can you guys hear me? Can you type yes in the chat box if you can hear me? All right, perfect. Allison says yes. I see lots of other people saying yes. Thank you very much for confirming that we do have audio. I want to go over a couple of technical aspects of this webinar so you know how to navigate everything. If you are interested in downloading a handout for this webinar, you can do so by clicking on the Handouts tab in the upper right-hand corner right there above the chat box. You're going to find a PDF version of these PowerPoint slides in case you want to take some notes. You can download that right now. The webinar will count as one continuing education unit or hour, and you can download your CEU certificate from that same handouts box again, or handouts tab, I'm sorry. Again, it's right above the chat box there, upper right-hand corner. If you do happen to miss any of today's webinar, rest assured we will be recording it and we will email you a follow-up email tomorrow with a link to the recording so that you can share it with your colleagues that you think might benefit from it or review anything that you missed. If you have questions, please type them in the chat box throughout the presentation. If our presenter is able to, he will answer them during the presentation. If not, I'll make sure to collect them and we'll answer them at the end of the presentation. So do type them in just as they come up. I want to highlight a few things that are happening here at NARI that you might be interested in exploring. So first and foremost, we have our NARI Fall Conference taking place in Las Vegas on October 2nd and 3rd. Registration is open. I hope to see all of you there. We gather the national NARI community at that event every year. So I'd love to see you there. I'll make sure to put a chat in the chat box so you can check out all the awesome education we have coming up free in the conference, and you can also register. We also have all of our certification preparatory courses starting in August. Can you type in the credentials of your certification if you hold a NARI certification in the chat box there? While you're doing that, so we have the Certified Remodeler certification, which is a top tier certification. That prep course is starting on August 30th. The Certified Kitchen and Bathroom Remodeler is starting on August 31st. The Certified Lead Carpenter starts on September 21st. The Certified Remodeling Project Manager program starts on September 28th. And then finally, the Universal Design Certified Professional preparatory course starts on October 24th. Those are all virtual courses, so you can take them from the comfort of your own home. You don't have to go anywhere, but they are live and in person via Zoom at least. So space is limited, so do register well ahead of time to make sure you can reserve yourself a spot in those programs, and then hopefully you can test and pass your certification and put some credentials behind your name, just like everybody here in the chat box. And then one last thing I want to mention is we do also have the Build a Better Remodeling Business workshop coming up on October 12th. Really valuable workshop to help you build out standard operating procedures and document the processes within your company. Really great way to systematize everything and take some administrative load off your plate and prepare your company to scale or for sale. And also, if you're pursuing the NARI accredited remodeling company credential for your company, that workshop is a really great way to prepare your company for that. So in 6 months, our goal is to get you to the point where you're able to apply for accreditation. And if you're not applying for accreditation, at least to get you to a better business. So again, that starts October 12th. I'll make sure to put a link to that in the chat box. But without further delay, I would like to introduce today's presenter, Fred Farris. Fred currently serves as CEO of the Aspire Institute. For over 18 years, Fred has imparted wisdom and proven business methods to thousands of business owners, with a laser focus on residential general contractors. Together with the Aspire coaches, GCs learn how to fully take control of their bottom lines and achieve better work-life balance at the same time. So without further delay, Fred, take it away.
Thank you. I appreciate that. Welcome, everybody. wanted to talk today about your remodeling business and making sure you're prepared for a recession. So let's jump into it. So kind of want to start with, why do contractors work so hard for too long and not make anything, and then get slammed every time there's a recession? Really what it comes down to is doing the right things. It's not about doing things right so much. It's my assumption that everybody here is honest and ethical, takes good care of their clients, does good projects, but there's more to the business than just that. We got to look at things like, how are we managing our job mix? What are the margins on each type of job mix? What does our business model actually look like? Because managing the business model is really the most important part of your business, and how you can protect yourself in any economy, whether it's a great economy or a down economy. Having a solid business model is going to be critical to make that happen. When we see whether it's a good market or a bad market, contractors struggle more than they should. We've just come off of arguably one of the best markets we've ever seen the last few years, and yet many of the contractors out there are not making the kind of money they should be making and working way too hard. And as the market starts to cool and things start to change, if we don't make some adjustments, it's going to get more difficult. So I want to talk about kind of how we do that. And the reason for that really is the net profit for GCs is way too low. The Construction and Financial Management Association does a survey every year, the last couple of years. The net profit average has been between 1.4 and 2.4%, which for the risk that we're taking for what we do as contractors, it's just not enough. If you look at any other investment, it's about the risk and reward, and we're not getting what we should in our industry. And largely, it's not about changing your pricing strategy so much as it's about managing the business and the process of your business. What we do is truly noble work. We do life-changing things for our clients, and we should be paid properly. Building the right business model is a big part of making that all happen. So being thoughtful about what are we actually keeping when it's all said and done, and how do we adjust that to make sure that we're keeping what we deserve and we're taking great care of our clients. We've been doing this for years, worked with thousands of contractors around the country, and we find that the net profit is, while it may not be as low as 1.4 to 2.4 every time, it's not where it should be. And really, there's a lot to it, and I want to talk about the different business aspects of that and how we make that happen. But one of the first things we need to think about is our strategy and tactics. As contractors, we are great at tactics. Our clients come to us with their goals, with their dreams, and it is our job to put together tactics to make that happen. But they come to us with the strategy, and we do the tactics. And too often we run our businesses the same way. We try this and try that. We look at other businesses and say, well, so-and-so is doing this marketing thing, or whatever it is. And so we try that in our business to see if it works. But we need to know what our strategy is, because if you don't know where you're going, you don't know which tactics are going to fit to make it happen. And too often we end up doing the wrong things, and not that they're bad, but they're not getting us to our goal. So you got to know kind of, where are you starting? Where are you here? Where now? Where do you want to go? And what's the path to make that happen? And so your strategy of where are you now and where do you want to get to is the most important part of your business. Once you understand what your strategy is or what you want to do, then we can look at what are the right tactics to get us to that point. If we want to go this direction and our tactics are taking us that direction, it's not going to be the right tactics for our business. So this really comes down to your business model, right? What is the business model that you're running now? And we all have a business model. It's the way that you acquire clients. It's the way that your sales process works. It's the way that your estimating and your production process work. And without a substantial change to that model, we're not going to get to our goals. And we have to step back and look at our business model, or I like to look at it as a machine. So imagine that your business is this machine, and on the top of the machine, you have all the revenue coming in, and it comes through and it pays your in-house labor and your sales and estimating and your materials and your subs and your indirect and related costs and your overhead. And what falls to the bottom is your net profit. If our net profit is too low, let's say it's in the 2 to 5% range, putting more revenue in the top of this machine is not going to fix our problem. We need to take the machine apart and rebuild it in a way that it generates, 15 or 20% net profit. And once we do that, then we can grow it as much as we want to. But if we don't really think about the business model and the process, it's not going to work. And there's a lot of different pieces to this, but understanding your business model, understanding what pieces we need to be focused on, what changes need to be made to get the right outcome, and working backwards. What do you want at the end of the year? How much revenue do you want as an owner? And how do I get that in the easiest, most sustainable way instead of the hardest way? Too often, we're looking at our business more of a commodities business, because that's, most of the input we get is from other businesses that are commodities businesses. And a service business and a commodities business are run very differently. In commodities, you have a fixed margin. In service businesses, there should be a variable margin based on each type of job. And we shouldn't be pricing everything the same way. A small kitchen versus a bathroom versus a whole home or an addition are going to have different margin targets and different risks and different liabilities that we need to account for in every job. And we need to be looking at our business model to identify what is the right mix for our business to get the outcome we're looking for. It's not just about let's work harder, let's take on more revenue, let's push, and grow the business top line, because we see businesses often that are doing $8, $10, $12 million in revenue and breaking even or even losing money. Would you rather run a business that's $10 million with a 2% margin, or a business that's $3 million with a 15% margin? And it's in your control. It's just about how you put the business model together. And by building a solid model with good margins, it will help you to both reinvest into your people, to your business, have savings, and most importantly, not need as much work to hit your goals, which will allow you to make it through any downturn that happens. So being thoughtful about your business model is important. A business model is several different pieces. It's how a business creates value. And as an industry, we do a pretty great job with creating value. What we do, like I said, is truly valuable to our clients. Delivering that value, we do a great job there as well. Finding and retaining customers that want that value, we start to slip a little there. Many of the times we're not really differentiating ourselves. We're not really targeting our ideal client and knowing who we're looking for and what types of jobs we're looking for. We're taking whatever comes in and trying to fill our schedule. A big challenge in our industry is trying to get the right work. But if we could be built out, 18 months with jobs and be looking for jobs to fill in after that, we can be more selective about the right type of work. If we're looking for jobs to start next month, we can take whatever comes our way. So then the last piece of this is really generating profit from that process. And that's where, as an industry, we fall down. We are not keeping what we should as an industry in gross profit and therefore net profit. And we need to be looking at our process, both in our efficiencies, in marketing to the right clients, in our sales process to build good value and take the client off the market and build through the process with them, estimating to make sure that we're covering all of our costs accurately, producing that product how we estimated it, making sure there's not waste in both materials, labor, sub overruns, things like that, and making sure that we keep our overhead in line so that we can have a net profit when it's all said and done. The problem is the impact of a disjointed or incorrect business model is that it limits our profits. It creates this reality distortion field where we kind of look at everything through our view of the world from our showroom, our front door out to the world. We get into the multiple bid fights. We try to be the cheapest. There's all these different reality distortions that come up that cause us challenges in business. And it creates a break even or too close to break even business. And the reality is 2 to 3% is way too close to break even. If the economy does slow, or when the economy does slow, because it will happen. If we're at 2 or 3%, we can afford 2 or 3% of a reduction in the economy and we're out of business. It kind of produces this cash flow driven business management where we're looking at making payroll or paying the bills. And so we take on whatever jobs come our way instead of looking at what is the right job for our business. What are we best at? What can we produce the best and make the best margin on? And then ultimately there's no real satisfying exit strategy and or business failure. We work until we can't anymore. I know so many contractors that have worked 30, 40, even 50 years, and they've had a decent life, but at the end of it, they close up shop or sell their business for the cost of a good used car. And that's not the best way for your legacy to continue. And there are other better ways, but we need to be thoughtful about our business model and how we put it together to be able to make that happen. In our experience, at least 90% of contractors have a significantly handicapped business model, and without making some substantial adjustments to that model, we'll probably not reach our goals. So it kind of comes back to that machine that I was talking about. We need to look at that machine and say, what is the right costs? Where should we be at? Of all of our different costs, what is the right, percentage for in-house labor, for sales and estimating, for project management, for materials, for subcontractors, all the different costs, and what are we keeping as a true gross profit? This is where looking at your P&L, while most P&Ls are accurate for FASB, they're not a great management tool to be able to really identify what's going on with the business. And so we need to look at our numbers in a little bit different way and break them out to be able to understand what are our true costs of production. On your P&L, for example, there's a lot of expenses that really are costs of production: labor costs, workman's comp, payroll taxes, vehicle costs, things like that, that may be in your overhead or your fixed expenses, but really those are job costs. And so we need to reallocate those above the line. Not that you need to change your P&L necessarily, because it is set for a different purpose. It is an accounting tool, right? It's for taxes. But we need to have a good business management tool to be able to understand what is really happening in our business and what things we need to change to improve and refine. But the bottom line is we have to optimize our business model to be successful no matter what the economy is. In a tough economy, it's critical. In a great economy, we're leaving money on the table if we don't have the optimized business model. So we need to be thoughtful about what is the right model for our business, how do we build that and refine it and get the right pieces in place so that we can produce a great product and have profit when it's all said and done. So I want to talk about the financial for a minute and get into the numbers so we kind of all understand what we're talking about here. When you're looking at your P&L, you have your total revenue. For most of us, the number on the top of the P&L, the total revenue, is all of the work that we did. Now and again, we work through escrow accounts or banks, and so the total revenue may be higher than that of what we actually produced. But in most cases, top line revenue is the total numbers that we brought through the business in a given period, a year, a month, whatever that is. But we don't get to keep all that money. We have to pay our fixed expenses. We have to pay a lot of other things. So you take that revenue, and then you have to deduct your production costs. And like I said, your production costs are all of the costs that would change if you did a job or that you had to take on because of that job. So estimating and sales costs are part of that. Production management costs, even if it's the owner, that time needs to be allocated. One of the challenges we see a lot is the owners of construction companies don't allocate their time into the estimating process or to the production process. And as the owner of the company, you are the owner and should take a profit, the net profit for the ownership of the business. But you're also an employee of the company in most cases, and the employee aspect should have a functional wage. So if you hired somebody to do that job, what would you have to pay for that to get that job produced? And that should be accounted for in your estimating process and in your production process, both on the sales and estimating side and the production or production management side of it. So once you take out all of the production costs, kind of think of production costs as any number that would change if we increased our volume. If you doubled your revenue, what numbers would increase? What things would you have to pay? Your labor costs would go up, your tax and benefit load would go up, your vehicle costs, your fuel, uniforms, vacation time, even things like workman's comp. All of those costs would change, and therefore those are costs of production. From there, you have what's called gross profit. That's, after we paid all the production costs, we have our gross profit. But again, you don't get to keep all that. The gross profit then pays your overhead, and whatever's left is net profit. And when you're looking at your overhead, really, it's things that wouldn't change if we did more work. So primarily, it's the office rent, the office insurance, utilities at the office, back office bookkeeping, management time in developing your team and hiring and staffing, those kinds of things that you would do regardless. But kind of think of overhead as if I locked the doors for 30 days, what would I not have to pay because we're not producing? And those would be overhead costs. So once we take the overhead costs out, then we have net profit. The problem that we see is when we put numbers to this, for every $1 million of revenue, let's say that we had a production cost fully loaded of $880,000, leaving us with $120,000 in gross profit. Our overhead is around 10% or $100,000. That leaves us with a 2% gross profit. This is not uncommon for clients that we see in different businesses that we work with. And we often get advice from our accountants or from other people saying that we need to sell more and spend less, meaning increase your revenue and decrease your overhead. But the reality is overhead's a tough number to decrease because most of us run fairly Spartan operations to start with. There's not a lot you can cut there. The real problem here is that our cost of production is too high through inefficiencies, meaning that our gross profit is too low. So in this example, we have about a 12% gross profit. Now, overhead in a construction business, depending on the size of the business, somewhere between 8 and 12% is pretty realistic. If you're a large company, closer to 8. If you're a smaller company, closer to 10 or 12. But when your gross profit and your overhead are within a couple of margin points of the same, the net profit's never going to be what it needs to be. So really the fix here would be to refine our processes to reduce our production cost, allowing us to have more gross profit. If we had a 10% reduction in production costs, that would give us $100,000 more in gross profit. That $100,000 increase would not change our overhead. It would therefore fall to the bottom line and be profit. So we need to be thoughtful about how we're putting our business together and being, watching our gross profit, because that's really, as a business owner, your job is to have the highest gross profit possible in the mix that you're doing while still giving your customer an excellent product. So really tracking and managing your gross profit is a critical role as a business owner. So at Aspire, we break down the numbers a little bit differently. I'm going to show you an example of kind of what that looks like, where we would go through the P&L and we would recategorize some things. So in this example, we have revenue at $2,539,000 rather. There's in-house labor cost of $586,000. There's owner contribution of $138,000 a year. So total wages are $724,000. But there's other loads. There's payroll taxes of $24,000. There's workman's comp of $29,000. There's vehicle costs of $26,000. So in this example, the total load is actually $80,600 more, making our total loaded labor cost $805,000, or almost 32% of our total. Material costs are $654,000 at 25.78, or almost 26%. There's a little bit of tools and equipment that we need to account for, $7,600. Subcontractors at $748, and then some other we call indirect or related costs that we need to account for at $13,000. So when you add up the job costs with the labor, the total cost of producing the product is $2.229 million, or 87.8% of our total, leaving us with $309,000 in gross profit, or about 12.2%. The overhead is, right about 10% at $259,000, but that only leaves us 2%, or almost $52,000 in net profit. So when we look at this, we got to say, where's the real problem and how do we fix it? And diagnosing the business by the numbers, looking at these key performance indicators and saying, where is the problem? The first thing that jumps out is, in a remodeling business, having a cost of production at 87.8% is too high. So we need to go back through and look at the different percentages. In-house labor at 31% and subs at 30%. We're spending more than 60% of our total in labor costs. So labor inefficiencies is something we want to look at. Are we selling all of the hours that we're buying? Too often we look at labor as a fixed cost, when really you need to look at labor as a product that we're buying and selling. That's one of the key differences between a service business and a commodities business. Labor is inventory that you buy and sell. So you buy 40 hours a week from every employee. If you don't sell those 40 hours, they expire Friday at 5 o'clock. It's no different than buying a stack of drywall or lumber. If you took the top 30% and threw it in the trash, you wouldn't be surprised you didn't make money on that drywall. But when we're buying 40 hours and only selling 30, we don't see it quite the same. And we need to understand that it is exactly the same. So understanding where our costs are, we see a lot of things like material overruns or waste, labor inefficiencies and productivity, sub overruns where we're getting a bid and they're coming in over that and we're not doing a change order, or we're not working with our subs. But if we can manage our costs and get our total cost of production down, that will give us a higher gross profit margin and therefore more net profit. The term "it falls to the bottom line" is referring to gross profit, because any increase in gross profit does not make your overhead go up, and it therefore falls to the net profit or to the bottom line. So really tracking and managing that is critical. Another aspect is to plug the profit leaks in your margins in your business. There's a lot of profit leaks we see in businesses where we're either not estimating properly or we're not producing properly. So looking at some key profit leaks, here's some areas where we see often businesses miss certain things or don't include them into our process. The first one is having a professional services agreement or a design agreement. As a professional, we should be paid through the design process and going through developing out the project. Taking a different approach to our sales and marketing, where we're educating our clients differently, helping them understand that we don't set the price, they set the price. It's based on what they want. And in the early phases, we don't know what that is. So giving them a price early on in an estimate is not what's best for them or for the builder. We're making too many assumptions at that point. We need to actually work with them to develop out and know exactly what they're looking for, what those specifications are, what their selections are, and be able to give them an accurate price. So the way that we recommend it is that you actually work with your client, understand what they're looking for, understand their vision and their goals, and then give them a range of cost. And that range can be fairly wide. You can make fairly big changes in selections that could be $50,000 or $100,000. So on a kitchen, we might give them a range of, $80,000 to $120,000, and educate them that, there's no way to know any closer than that until we work through and develop out the project so that we know exactly what it's going to take and we can make sure you get the outcome you're looking for. If we make an assumption too early and guess, then there's too big of a chance that either it's not going to be what you want or it's going to have price overruns along the way with change orders because the assumptions we made weren't correct. And we don't want you to have to go through that, Mr. Customer, and have that bad experience. And so we want to do this a little bit differently to help you to have a good outcome. By spending a little bit of time up front and developing out the project, we know exact costs, we know availability on product and subs, we can schedule it, and we can get it produced more efficiently, which will actually cost the construction company a little bit less and save the customer money while still getting a great product. So that's an area that you really want to focus on and make sure that you're building in that time. Also, your time for that process needs to be paid for, because we can't just donate that time and then not get the job. The next one is pre-construction job organization stuff. There's a lot to that. Are we covering all of our cost of pre-con? The developing of the project, a lot of this will be covered in a design agreement or a professional services agreement, but there's other things like job site mobilization and teardown that needs to be included in your estimate. Other estimating deficiencies like production inefficiencies in our labor costs, or not including all of our indirect or related costs, a lot of the small supplies that we don't often include in there. Sometimes we see contract problems where, especially in the last few years, things like not having an enforceable escalation clause that's tied to the consumer index, where if prices do escalate, we can go back to the client and say, hey, unfortunately, when we bid this, the prices on lumber were here, they've now moved to here, and so we're going to have to charge you that difference. We see often not charging for all of the owner time or project management time in the bid, making sure you're including all of those hours. That's not an overhead cost. That is a cost of production. If we didn't do the job, we wouldn't need to have a project manager. Change orders is another one. Even though a lot of contractors think they're doing change orders, what we find is that we're not doing the process properly, or we're not communicating properly on both the cost difference and the time difference in the project. And so we end up giving some of that back at the end of the job because it went too long. So really having a solid change order process is important. A change order is a new contract. We've changed the rules of the first contract, so we're pausing the original agreement. We're going into a change order. We're doing the change. We're getting paid for the change, and we're going back to the original contract with a new completion date based on how many weeks or months that change pushed it out. And a lot of times, even though the change order only takes 2 or 3 days, it may push your schedule 2 or 3 weeks with your subs and getting everything back in there and getting it handled. Productivity is another big one. I talked about that, but really understanding what is our productivity? How many hours are we buying and selling and tracking and managing our labor inventory? and making sure that we're covering that. Sometimes we find that when we have in-house labor, our crew is great at certain aspects of the project, but not as good at other aspects. So we need to look at that and say, we're doing great here, but we need to improve here, or we need to sub that out. So can we do training in-house to get better at drywall, for example, or finish work, or should we sub that out until we get better at it? But we need to be looking at the inventory that we're buying and selling and making sure that our productivity is in the right range. Sometimes 100% productivity, by the way, is not ideal. Oftentimes you may want to slow down a little bit and make sure we don't have rework. But we need to factor that in. So when you're building out a labor rate analysis with your total labor load, once you know what that cost is, we may need to put in a production factor of 90% or 80% based on the type of job, the location of the job, and different factors to make sure that we're covering that cost. In a lot of markets, we're less productive in the winter than we are in the summer. If the job is more than 15 or 20 miles away from the office, maybe we need to have a little bit lower production factor because there's drive time included. But be thoughtful about your productivity on each job and make sure that we're covering all of that. We see a lot of indirect and related construction costs that are missed often. Things like the small hand tools that wear out, a percentage of that is going to be used on every job. It needs to be accounted for. Bond or insurance costs, sometimes cell phones, uniforms, like I said, vehicle costs, fuel costs, road tolls. There's a lot of different things that we need to be looking at and say, is this a cost that we incurred because we did that job? And if so, it needs to be put into that job, or it needs to be spread across all of our jobs as a percentage, and maybe a general conditions line or something like that to make sure that we're covering those costs. Material ordering and handling is an important one, making sure we have the right material on the job so that we're not standing around. We see a lot of issues here with not having what we need and then running to the hardware store and it costing us a lot more than we realize. A trip to the hardware store is 3 hours when it's all said and done. By the time we stop, realize we're missing that, talk about it, go to the store, come back and get back to work, it's 3 hours of production time lost. If we could reduce the number of trips we're making, if we could have the material on site when we need it, make sure it's the right material, make sure that it's staged properly so that we're not moving it 2 or 3 times, because that's also a production loss as well. We'll be able to refine our process and have a better gross profit. The last one is the punch list process. We see a lot that the punch list process ends up costing us. We go back multiple times, so we're not getting that last check until it's done, and so it delays the final payment. So really having a good punch list process. Ideally, you want to finish strong and make sure you have as small a punch list as possible. But some of this is just in how you educate or the expectation management, I should say, with the client. How do we educate the client and help them understand what a punch list looks like and how we manage that process? One of the things that we like a lot is what we call a 3-step punch list process. And this needs to be built into your estimate for the hours. But in the beginning, before you've even sold the project, part of you differentiating yourself and helping the client understand how your process is different, you might say, we have a 3-step punch list process because it's important to us that everything is perfect and that you have a great outcome. So at the end of the job, we will walk through with you, and anything that you notice we'll take care of. But we're then going to schedule a time 6 weeks later, and we're going to call you, go over anything that you found, and we're going to come back in 6 weeks, and we're going to take care of anything that's on your list to make sure that, if you miss something or there's any issues, we get it taken care of. And we're going to take it one step further, and we're going to come back at 11 months and do a final walkthrough. Usually on the 11th month, there's some other things. We might do a HVAC filter or smoke alarm batteries or a few other things. But most of the products we've installed have a 1-year warranty, and we want to come back and just do a final inspection to make sure everything's perfect before that warranty expires, because it's important to us that you have an excellent process and project. And by building that value ahead, they realize that you care more than just the money. You care about them and their product, and they appreciate that, and it builds value. The other nice thing is that 11-month meeting actually turns into a sales meeting more often than it doesn't. If we remodeled the kitchen a year later, when we come back, we're thinking about doing another project. And so it often turns into another opportunity. So it can actually be a good marketing tool, as well as managing your process and being, building good value with your client and being profitable. So some areas to watch out for and be able to refine. The thing with profit leaks is that they leak gross profit. It's things that we didn't account for. So it's not revenue, it just is eroding our profitability. Too often we use a fixed markup across the board, maybe a 20% or 25% markup across the board. But the reality is a 20% markup is not a 20% margin. It's a 16.7% margin. The math is different on markup and margin. We need to understand that. And if we start with a 16.7% true margin, and then we have 4 or 5% profit leak, now we're down in the 12% range, which is what we see way too often. And so fixing some profit leaks, if we can get 2 to 8% in better margin through the profit leaks, that would be the same outcome as 50% more top line revenue, because gross profit has such an impact on that. So being thoughtful about how we put our process together, managing all the different pieces, and working with the right clients to build good value, and building that model, the business model to achieve the profitability that we're looking for, is critical. The next thing I want to talk about is understanding and managing your job mix. Job mix is an area that is way too often overlooked. The reality is every project that you do does not have the same risk. It does not have the same profit potential. And every company is good at certain things and not good at other things, or less good at other things. So you really need to be thoughtful about how are we putting our business model together? What are the ideal job mixes and therefore clients for our business? Part of what we do is building out some projections. And I don't have a pointer to show you how this works, but if you look up at the top where it says current snapshot, that is the numbers we talked about earlier, right? So we have revenue of 2.539 million, the total cost of goods at 2.229 at 87.8%, gross profit at 309, almost 310,000 at 12.2%, overhead at 257,000 at 10.16%, and net profit at 51.9 at 2%. In this example, this business did 76 projects, so the average project size was $33,000. So the way that we want to build this is kind of build backwards. Instead of let's chase top line revenue and let's get to 5 million or 10 million or whatever that number is, let's build it the other direction. Ideally, you want to say, I want to get X amount of profit. I want to make this much money, and I want to do it in the easiest, most sustainable way possible. So how do I do that? So where it says goal GP or goal gross profit, let's say that we wanted to up our overhead from 259 to 300 because we wanted to get a little bit more help in the office to make our lives a little bit easier. And then we wanted to make a true $350,000 net profit after we've taken a functional paycheck for what we do in the business. So we need, therefore, $650,000 in gross profit to make that happen. So how do we get to 650 in gross profit in the easiest, most sustainable way possible? So if you look in the middle where it says current model projections, this is the model that this particular business is running now. We're doing remodel projects at about $80,000. We're shooting for a 25% gross profit, but we're landing at a 12.2% actual gross profit, which means we have a 48.8% efficiency. That efficiency number is the 12.2 divided by the 25. We're also doing some smaller projects at 30,000 that we're trying to get a 30% margin, but we're still landing at 12.2, which means we have a 40.68% efficiency there. If our revenue was 70% from the remodels and 30% from the smaller projects, we would need to do 3.7 million and 46 remodels and almost 6 million and 53 smaller projects to hit that 650 goal. So if you look in the top where it says current model, we'd have to do $5.3 million in revenue in our current business model with a 12.2% gross profit, and that would be almost 100 jobs a year to make that happen. But if we made some adjustments to our business model and we drop down to where it says improved model projections at the bottom, let's say that we went from $80,000 average projects to $100,000 average projects, and we got a 32% margin instead of a 25% margin. And we got our efficiency to 95%, not 100, but much better than the 48 that we're at now. And then we moved our smaller jobs up to about 40,000 with a 38% margin. And on those smaller projects, we see an efficiency drop a little bit. So let's put 90 there. Then we would need to do 30 remodels and 34 smaller projects. Those would be our margins. 30% gross profit and 34% margin on the smaller projects would be our actual. If we shifted our mix to 75 and 25% in revenue, we would need to do 15 or about 1.5 million in remodels and about 500,000 or about 13 jobs in the smaller projects. So if you look up at the top right-hand corner, we could actually get that same outcome with $2 million in revenue. We would have a blended gross profit margin of 31.35%. Our overhead would actually come up a little bit because our revenue dropped, so it'd be 14.7 or 47, and we would have net profit of 16 or the 350,000. So we could hit that 650,000 gross profit goal and 350 net profit goal with 28 and a half jobs instead of the 76 we're running now. But to do that, we need to be thoughtful about our business model and how we put this together. So part of this process is identifying what is the ideal business model for you or different job mix for you. And then how do we market to that? Because marketing to a $100,000 remodel that we can get a 32% margin on is a very specific type of client. And we need to know who is that client, where do they live, what areas of our market do we need to attract them from. The same thing with the $40,000 job at a 38% margin. That is a different and very specific type of client. And we're thoughtful about where we're getting those clients from and how we're marketing to them. What does that sales process look like to build value to make sure that we can get those jobs? You know, the big focus here is that it's not about taking all of the jobs. We don't need all of the work. You know, we may end up changing our process and not being a great fit for all of the clients that we have been working on, but we're doing 76 projects now and making, 2.5 in top line revenue and only 52,000 basically net profit. If we drop down to 28 and a half jobs and had a revenue of 2 million, we would be able to get a higher margin, spend more time with each client, build a better value, better relationship, and actually make more money. So being thoughtful about how you build your business model is critical. And if anybody has more questions about this or would like to know more about this or have this built out, we can help you with that, not a problem. But really what it comes down to is you need to understand your business model. So kind of another way to look at this is, let's say that your goal was to make $250,000 a year in your business. You wanted to take 85,000 as a salary working in the back office. We had 120 of true overhead once we pulled out all of the variable costs, and we wanted to generate an additional 175 in net profit. So you'd keep the 85 salary and the 175 net. That would get you to the $250,000. So we need $380,000 in gross profit to make that work. So how much revenue do we need to make that happen? And really it comes down to, what is your profit? What is your gross profit? So at a 10% margin, which we see clients at 10% often, we would need to do $3.8 million in revenue. That would give us the 380. But if we had a 15% margin, we could hit that same 380 at 2.5 million. If we were at a 25% margin, we could do it at 1.5 million. If we got to 35, which is realistic if you reshape your business and hit the right targets, we could do it at just over $1 million. So it's not about top line revenue. Top line revenue is an outcome number based on what we want to keep in gross profit and how we've built our business model and what our average gross profit margin is. Then there will be a target revenue based on those numbers. And it's not about let's do as much work as possible and hope that there's some profit left. It's about how do we build our business machine that generates the correct output and doesn't kill us in the process. So kind of looking at that another way, we have these two different model examples. Model one, we have 51 jobs per year with a $75,000 average job size and 3.8 million in revenue with a 10% margin. We'd have $380,000 in gross profit and the 205 overhead, including our paycheck. So then we'd have 175 in net profit. But if we shifted that and we dropped from 51 jobs down to 18 jobs, we increased our average job size to 85 instead of 75. And that's not charging $10,000 more necessarily. In that $75,000 average, there's going to be some larger jobs and smaller jobs. Some of the smaller jobs aren't going to pay as well or have as good a margin. So if we're going to cut from 51 to 18, we're not going to cut the highest profitable jobs. We're going to cut the other jobs. We reduce our revenue down to 1.5 million, get our margin up to 25%, and we have the same $380,000 in profit, 205 in overhead, and 175 in net profit. So being smarter about how we put our business together, knowing exactly how many jobs in each job mix at what margin we need to achieve that goal is important for our marketing, for our sales process, for our staffing, for our production, for all aspects of our business. If we don't know what we're trying to achieve, the chances of us accidentally landing on the right numbers are going to be unlikely. From here, you can always make more money, right? Maybe we want to be at 3.8 million in revenue. There's nothing wrong with that, but let's do it this way. If we want 3.8 million, instead of doing it with 51 jobs at 75,000 per job and a 10% margin, let's do it with 44 jobs at 85,000 with a 25% margin. We'll still do 3.8 million, but we'll have real profit now of 745,000 instead of 175. The profit potential is unlimited based on how you want to build your business and where you want to get, but having the right business model or business machine to make that happen is critical. So be thoughtful about how you put it together, because every aspect down to, from your marketing to your sales process, how you estimate, how you produce, what your staffing model is, all of these things come from what are we trying to accomplish? What is that model? So that's part of your strategic planning. What is the strategy for my business? What do I want to have? And then what tactics or what pieces do I put in place to get there? The last thing I want to talk about is marketing, making sure that we're adjusting our marketing and refining our process to really attract the right clients. Too often our marketing strategy is referrals or the phone's ringing off the hook, and so we just take whatever jobs come our way. But we really want to be thoughtful about our marketing and be selecting the right jobs that fit our ideal clients and our ideal job mix with the margin targets that we're looking for, so that we can build that healthy, strong business. So some keys to great contractor marketing is finding and exploiting what makes you special or different or unique. You can't be the same as everybody else and be different, right? If we're the same as everybody else, then we better be the cheapest, right? Once the saying, all things being equal, I'll buy at the cheapest place. All things being equal, we need to be different somehow. We need to change our process. So having a unique feature or being a specialty, maybe we're a specialty kitchen remodeler. Being the best is really difficult. There are awards and different things out there, but it's really difficult for our clients to use that as a differentiation, because from their perspective, what they understand of the industry, it's tough for them to say, why are you better or why are you the best? It's a difficult position. It can be done, but it's challenging. But really it comes down to, what is your competitive advantage or your unique value proposition? What differentiates you in the marketplace? Why should I, as a client, pick your company to work with? So be thoughtful about what is your differentiation, because all marketing strategy is built on a competitive advantage, and it's either price or it's an actual competitive advantage. If your competitive advantage is tied to your differentiation and you separate yourself in the marketplace, tied to the ideal client that you're looking for, you will have much better success. So it kind of starts with building your business model. What is the job mixes you're looking for? Who is that ideal client? What do they look like? What are they going to be attracted to? What differentiator is going to appeal to them? And how do we use that to get their attention? So don't compete to be the best, but compete to be special or different. And there's so many ways to do that in remodeling. Great customer service, time to completion, on-time budgeting, in-house design. There's a lot of different options that we can use as our differentiator, but it needs to tie to your ideal client. Really, your differentiation is, why does the client pick you? It's a way for them to clearly, either emotionally or functionally see the benefits of working with your company over somebody else. Why are you the best fit for my project? So spend some time understanding what that is and how that works, because your differentiation is a business strategy. It's how you get your margins where they need to be. Every business does this. You have to prove it. You can't just write it or say it. It has to be part of your business culture or who you are as a company. Everybody in the company should know who we are and how we differentiate ourselves. But you can price yourself 5 to 10% above competitive pricing levels if you effectively differentiate yourself in the market and you're worth that extra. But it's really about finding the ideal clients that are looking for the service that you're offering. And if we can do that, then we can move up market. We can be more selective about the jobs we're taking. By building out the right marketing and sales process tied to the job mix that we're looking for and differentiating ourselves properly, we can schedule out further. We can be more selective about the jobs we take and make sure we're taking profitable jobs that will allow us to hit the margin targets we're looking for while taking great care of our clients. So there are 5 kind of key differentiation options or ways to differentiate yourself. Price is the easiest or kind of lowest hanging fruit. The problem with price is that you'll go out of business. You know, when you win on price, you're going to lose overall. So don't let it be price. But specialization, you know, specializing in high-end custom kitchens or baths or additions or ADUs, or there's a lot of different specializations. Build quality can be one, but be thoughtful about where your client's starting point is and how much they understand about build quality and how you educate them on what that means. A lot of times things like longer warranties are a good option with build quality as a differentiation. Customer experience is a great one. Sadly, our industry has fairly poor customer experience. Part of this is in not planning correctly. You know, in the PSA process and building out your process and working through and really understanding what we're going to do and what our timelines are and setting the right expectations with the client, we can give them a much better experience. When we're trying to make decisions along the project, there's delays and challenges and cost overruns that actually end up costing, you know, that value that we've tried to build with our client. So customer experience can be a great one. A unique feature, maybe like a green builder or something like that. If that's something that plays well in your market, that could be an option as well. But be thoughtful about what the differentiation is for your market that's going to appeal to the ideal client you're looking for. And this becomes your marketing lead. It's something that the right buyer connects with. It's how they pick you out of the crowded marketplace. And the most important part is without a clear differentiation, you drop back down to the price as the default. And then you get into the multiple bid, you get into, you know, fighting over the scraps of what's left, basically. And that's not where you want to be. We need to be in the right market, move up to the client level that we're looking for and make sure that we can appeal to and give good value to those clients. So by focusing on these areas of your business, you can really shore up your business, have a healthy business that will get through any downturn. But even better than that is when in a good market, you'll do fantastic, and in a down market, you'll still do great. So fixing your business model and your machine, focusing on really building the right process, understanding your business, what is the right job mix, and marketing correctly, you will be able to be successful in any market, really. So the key takeaways here today are take time to build your business model that will achieve your goals. Be thoughtful about what those goals are and how you build that. Focus on your margin management, refining your job mix, and marketing to your ideal clients. And make sure that you've built a healthy business that can withstand anything that comes along. One other thing, if you would like, we have a recession risk analysis on our website. If you go to our website to the resources page, there's a free recession risk analysis you can fill out. It'll give you some information on kind of different areas you need to focus on or what you may need to do if we're not in good shape for a coming recession. And if you have any questions on that, feel free to reach out to us and we're happy to help you. Otherwise, that's the end of my presentation. Thank you so much for your time. I hope it was useful for you. Let me know if you have any questions.
Thank you, Fred. Wonderful presentation, very relevant. You know, hopefully we don't get to a recession, but I know that's still a possibility. I wanted to just, I'm going to take a couple minutes to just reiterate a couple of things that I talked about at the beginning while people are writing their questions, because we do still have a little bit of a time for Q&A here. But, you know, just a quick reminder, I hope you'll all join us for the NARI annual conference on October 2nd and 3rd in Las Vegas. We've got a lot of great education planned for you. If you've got somebody on your team that you'd like to get some credentialing, some training behind their names, you know, make sure to sign them up for a certification. We've got those prep courses for those certifications starting in the fall or late summer, I guess, August 30th. And then the Build a Better Remodeling Business Workshop starts on the 12th of October. But what I am seeing in the chat box, Fred, are not questions, but appreciation for your presentation. So it looks like you were pretty thorough. And I think that's probably going to be it for us today. I really appreciate you being here with us and delivering this valuable education to our members. Do you have any parting words before we sign off today?
Thank you so much for having us, and I hope it was useful for everybody. If anyone does have questions that are more specific about their business, if they'd like to email me, I'm happy to help with whatever I can. Like I said, we have the recession risk analysis. You're more than welcome to fill out. I'll give you some great information. And if anybody would like to have us build that roadmap analysis that we talked about, breaking down the numbers, email me and I can set that up for you at no cost as well.
Thank you very much, Fred. Thank you to our members who joined us today, and I hope everybody has a great rest of your week and a good weekend.
All right, thank you guys very much.